subscribe now and press the bell icon. Never miss an update.
We did all these examples last time, right? If there is a stock split, how do we allocate the basis to all the stocks? Or if there are more stock dividends issued, and if it's a non-taxable transaction, we need to make sure that the basis is adjusted. We need to go with the FMV as the golden rule. What was the fair market value of the original stock when the new shares were issued or new stocks were given as dividend? Okay, and what is the value of the dividend stocks? Again, if there are different classes of stock, how do we do that? Common stock, preference stock, and all. But the underlying is the fundamental there is that we have to take the FMV. So we'll have to take the ratio of fair market value of these two different categories and split up the original basis needs to be split up in the said ratio, because we are not going to change the basis when it's a non-taxable transaction. So earlier the basis was 200, even now it stayed to 200 only. It's just that it got split up between what should go towards common stock, what should go towards preferred stock. Right? And then we saw that if the stocks were, they had different bases, because once one transaction took place, say at one point of time, after that same stocks were bought but at a different price, and then the dividends were issued on all the stocks that a shareholder was holding. So now how do we split up the basis? I hope you guys remember all these things what we did. Okay, our basis still remains same. It's just that per unit basis or per stock basis will change, but the aggregate basis, the value of total stocks, will still remain same. If it's a taxable transaction, then obviously basis gets changed, both aggregate and per unit. Why? Because we are getting some income in hand which has been offered for taxation. Because if it's a taxable transaction, that means there's some tax which is being paid. And that will always adjust the basis, aggregate basis as well. Not just obviously if the aggregate gets changed, per unit will automatically get changed. Right? That's out of question. Okay, so those are typical, those are a bit complicated, like stock rights, stock dividends, and those kind of issues. But let's just continue here, and then we'll see what other adjustments can we do to the asset basis. And so the basis needs to be adjusted for certain events, for certain tax related events. What can be those? Any acquisition, certain expenditures subsequent to acquisition of property costs, legal fees, title insurance premium. They're not talking about regular annual premium, only title insurance premium, because these are all one time cost. Premiums are paid, like insurance premiums are paid every year, but that will not add up to the basis. Yes, but if you're getting some addition done to the property every year, then it's a capital cost. But if you're doing the regular repairs and maintenance, okay, something got broken, or this is chipping off, let's just put some paint, or this part is falling off, or the roof needs some repairs, something is like it's like it's not working right there, and we're just getting the normal repairs done, that will be a normal expenditure. Okay, so let's see what kind of expenditure have any impact on the life of the asset. Again, this is a very, very basic rule. We must have read about it in our 11th grade, 12th grade, whenever you decided to take up commerce and all that. Anything that increases the life of the asset by at least 1 year or materially increases its value needs to be capitalized. Okay, this could be new improvement, all these things. Generally, Generally, repairs, maintenance are operating cost and they are not capitalized. An increase to basis may result from a liability to the extent it is secured by real property and extend its life. That may also happen that increase the basis may need to be adjusted because of certain liability attached to that property. Depreciation, there could be different ways the property can be depreciated. We need to first understand what is the nature of that property. And depreciation will come into the picture only if the property is put up for some business use. If it's a personal property, I don't need to depreciate that, because that, again, I mean, you can depreciate it, put it in your books and all, but what's the point? You're not going to get any tax benefit on it. But if it's a business property, that's when the depreciation comes into the picture. Or if it's a personal property put up for some use where you're generating income out of it, then obviously depreciation needs to be calculated. This is called makers depreciation. This is a very common term that you will see. Makers, which is like modified accelerated cost recovery system. We'll look into it. What does that mean? It's the name itself says it's a modified accelerated way of depreciation. And under that there could be GDS, general depreciation system, and all, and they're giving certain example that if the asset is falling under certain category, how it needs to be depreciated. These rules are standard. The software will also give you this rule. That's why we need to put in what is the nature of that asset. Is this a furniture or a computer or an equipment or a real property? Okay, so any office machinery and all those things, furniture and carpet, even computers and all, they'll go with 5-year rule. Other office furniture, like office machinery and all, is fine. And and it's saying appliances, carpet, furniture used in residential real estate activity. That's a, so let's not get confused. That will go for 5-year property, but generally, furniture goes for 7-year depreciation basis. Residential real property, it can go up to 27 and a half years. We have always seen that whenever we do rental schedule, which is schedule E for rental income. If it's a domestic property, we'll probably put it for 27 and a half years, because most of them are residential real property. If it's a non-residential real property, which could include like office buildings and warehouses and all, and for them it's like 39 years. Even foreign property, how many years do we need to go with? Okay, so that will go for 39 years. Okay, the basis must be reduced by the depreciation allowed and all that we all know. Section 179, this is a very important section. Section 179 allows us to take an expense of up to $1 million, for certain classes of property. So right away, 100% of that can be depreciated. That means instead of spreading it over 5 years, 7 year, 27-year, and all those things, if it satisfies certain conditions, and a lot of time it will, it's not something which looks like high hanging fruits and all. We have taken this benefit for a lot of clients, and section 179 is a very, very important clause. It gives more benefits, so it can go up to $1,080,000. We have to see whether that asset will go for section 179 deduction or not, but that will come under depreciation only. If the entity is already making losses, you may not be able to deduct section 179 expense. It just goes up as carry forward to next year. Okay, then let's look into contributed property. So a shareholder does not recognize gain on the voluntary contribution of capital to a corporation. Obviously, if a shareholder comes and says that, okay, I'm going to contribute this, or I mean, it doesn't have to be big corporation, it can be small corporation and they may need assets. There's no gain or loss on that. It's just that the stock basis will increase with whatever he's putting in. It's just like putting in more money and buying the stocks. So instead of putting in money, the shareholder is contributing in the way of some property. So we have to see what will be the new basis in the property. Dividends, obviously, dividend out of earning and profits are taxable. But if there are dividends which just change the basis, not the aggregate basis, per unit basis, then they are not taxable. And if they come up as taxable, then they do not reduce basis. See, either we can, if something is coming up as taxable, they're not going to reduce the basis because it's a separate transaction. Nothing has to do with basis. Cash is given as dividend and we report that as income. We pay taxes on it. That's all. It's done. The assets on which the dividend has been declared, that doesn't get changed. Okay, let's go through return of capital. If a corporation makes a distribution, again, that's a either return of capital or dividends or distribution, whatever you want to call it. But dividends are usually out of earnings and profit. But a corporation just wants to give away the capital, saying that okay, we're going to buy back it or just take it out and all those things, which is not out of ENP. It is a non-taxable return of capital until its basis is reduced to zero. So let's say if the person has put in $100,000 and the corporation has given $50,000 back, it is a non-taxable transaction. Why? Because now the new basis will be 100 minus 50. But if the basis was 100,000 and corporation says, well, we have a lot of extra money sitting here, we'll give you like $200,000 back, then it is an income for the shareholder, whatever way you want to call it, dividend or return of capital, or but it is an income, and that will be taxable. Okay, if we now again this thing we have already seen it earlier. If we don't know which lot exactly we are going to get it for, then we just go with FIFO method. When specific identification is impossible, when we don't know that a lot of different stocks we have and we are not able to specifically identify, then we just go with FIFO method. And if you are able to identify the different lots, different times, and different prices on which it was bought and all, then we have to go with a specific lot and see how much return or how much distribution needs to apply to lot A versus lot B versus lot C. If you're not able to do it, just go with okay, what was it which was bought first. So first in, first out. Stock rights, we have already covered this up. I'm not going to like put in too much time here, but we can just quickly go over that. And I would just want Garima, can you read this and just explain what that is?
Yes, ma'am. Stock rights. The basis of stock acquired in a non-taxable distribution, example stock rights, is allocated a portion of the basis of stock upon which the distribution was made. A. If the new shares and old shares are not identical, the basis is allocated in proportion to the FMV of the original stock and the distribution as of the date of distribution. Second, if the new shares and old shares are identical, example stock splits, the old basis is simply dividend among the new total shares. Third, if the FMV of the stock rights is less than 15% of the FMV of the stock upon which it was issued, the rights have a zero basis unless an election is made to allocate basis.
Right.
Fine. So, the condition first, if the new shares and old shares are not identical, then we take FMV as then we take FMV, we take a basis as a proportion of the FMV.
On the distribution date. So we need to see what was the FMV when this distribution happened, right? Because this is a non-taxable transaction. We're using the same basis, just splitting it up in the proper ratio.
Ma'am, regarding second point, stock splits, so these are non-taxable, right?
Right. These are non-taxable. We saw one of the example here, right? Yeah, this is a stock split. We saw this example. The total price was $550 for 100 share. earlier when the person has bought it. So 5.5 was the per share basis. Now the same price has to be allocated between 110 stocks. Why? Because 1 is to 10, the dividend was issued. Sorry, this is not a split, but the dividend was issued. But it's the same. It's the same kind of concept. So now the total stock which is being held is 110, and now you use the same aggregate and then divide it, and we get the different value per share. Same thing needs to be done with split. It's the same thing. So if like there is 100 stock, 1 is to 2 they do, then the shareholder gets 100 more. So the total stock after the split will be 200. But the basis still stays same.
Same.
Correct?
Yes, ma'am.
Okay, so let's go there. Where were we? Yeah, and then this is a rule that we just need to remember. If the FMV of the right that has been given is less than 15% of the total FMV of the stock which was in hand, then we don't have to give any basis to the rights stock. Just make them as zero. Because what is IRS saying, it's too small, that like that whatever stocks you're holding, as compared to that, it's even less than 15%. Just have a zero basis just to make it simple. But if you want saying that, oh no, I want to allocate some basis to it, then that's fine. There's some election that we need to make, and we can still allocate basis. It's just to have some simplicity. They just said that just make it zero because it's too small of a number. But if you say no, I don't want to do that, then fine, just make an election saying that I'm not going to go with this rule. I want to give some basis to these stocks as well. And then again, follow the same thing, the fair market value of old share, new share, take the ratio and then do it. Let's go to some tax benefits and also, okay, any items which are giving some tax benefits, which are resulting into some tax benefits, in that case, the basis adjustments have to follow. Okay, like for example, what, like if there is a rebate, sorry, not rebate, if there is a credit, energy credit given on the solar panels which are being installed. Solar panel is a capital asset item. There is a tax benefit given on them. Then that benefit, what you're getting, should adjust the basis. Otherwise, you take that as income, right? But somebody needs to take it is a benefit which is given to taxpayer. So instead of reporting that as income and paying taxes on it, that will be too complicated. What IRS is saying is just reduce your basis. So tomorrow when you're selling off the asset, at least your capital gains or losses are computed accordingly. Casualty losses, any kind of casualty could be fire, theft. If there are losses, basically the amount which is not covered by insurance and all, we can always adjust that amount to, and if you're getting a tax benefit on it, right? Because casualty losses were deductible, like until there were a few years in between from 2018 through 2025 when they have limited the deduction. They have limited the deduction to casualty gains. There could be some gains, like maybe suddenly some rezoning has been done and this land becomes higher in value, or something else happens. There's some kind of gains there. You find something, so there could be all casualty gains. Or if it's a federally declared disaster, then only we can take casualty losses. Earlier, even if it's not federally declared, like some accident happened, right, and then some car crashed into your house or something happened, or there is an accident, there's some short circuit or something and the house is caught fire, house caught fire, even that would be considered as casualty losses. But now what they're saying is, it has to be limited to certain events. If the government has declared that there is a disaster in this area, that means the natural loss which is happening due to all these different weather conditions, or something which is not controllable by the man, right? So in those cases they will declare it as a disaster area, and we can take that as a loss. Or if there are any gains, then the loss can offset those gains if it's non-federally declared. But all these things, they will have an impact on the basis. So like example, if the house is for $500,000, there is some casualty losses that we have you know we have applied for. After insurance and all, there is still like say $100,000 or whatever you got the loss benefit. Then that benefit should adjust the basis also of the property again. So that is all something we need to put a record of it and all what has happened, because again after a few years, if you're selling off the property and all, that needs to be calculated in the right way, because there is a benefit given. Any debt discharge, any kind of debt which is not like, now you don't have to pay it, like some farmers debt, they get forgiven, or some other kind of debts if the economy is going through different situation and all. So any of those debts, if they're forgiven, or but exclusion for gross income, if the person is like applying for insolvency and all, and as part of that the court is saying, well, okay, you have total liability of $5 million, since you're insolvent, maybe it gets reduced to $500,000, just pay that off and you're done, and you're declared insolvent or bankrupt and all. That doesn't mean that we need to take that $4.5 million as income for this person. Usually when the debt is written off, that becomes an income in the normal situation, but not in the case of insolvency. Credit on any assets purchased. This is some same example that I gave. If there is a building, a rehab, or energy equipment, or solar panels, things like that have been installed, and if we are getting some kind of credit back from the government in the form of tax benefit, that will adjust the basis of the property. Any partial disposition of property, if the whole property, like, there's a huge land, say like some 50 acres, 100 acres, and we are splitting it off, plotting it, selling some different units, then obviously the entire basis has to be apportioned in a proper equitable way. So again, this is again very important, how to do that. Shall we use FMV? Shall we use the original basis? How do we split it up and all? So when we also have to use the relative FMV is used to come up with the ratio what should be done. Personal use converted to business use. If there's a personal property which we are converting to business property, this also we have seen earlier. We have to use the lesser of FMV or the basis of the property at the conversion date. Whatever is the lesser amount, that could be used for the purpose of business. Now, this is again very important, because if the personal use property converts to business use, that means you can claim depreciation on that. You can claim all expenses that we are putting on property as addition to capital assets or as part of maintenance and all. So where to start from, what basis to take, and also this is an important rule we should remember. Any leasehold improvements, leasehold meaning any rental property. So generally, like if the tenant comes and says, well, I don't like this thing, I don't like this washing machine that you have, I'm gonna put my own brand and all those things, but that doesn't become an income to the landlord. Maybe the tenant will leave it there and go back and all, but that's their choice. But if something like the whole plumbing has gone damaged, and then the tenant goes to the landlord saying that, okay, this needs to be fixed and all those things, and they're getting it done, obviously that becomes a addition to the basis. Okay, so you cannot take it back. So that doesn't mean that there is an income for the lesser. That doesn't mean that there is the basis needs to be adjusted, and we will say the lesser has a zero basis in those leasehold improvements. Sometimes they may want a shade, saying, okay, I want to keep my car here, I'll just construct my own shade, or I want some shelves here in this room, or I'm not liking maybe I want something else, like maybe some more air conditioning to be installed and all, and maybe it's not the one that you can take it out, maybe it's attached to the property. Then at the time of termination of the lease, the tenant will just leave it there and go. But that doesn't become the income for the landlord, and that's why it doesn't even have any basis and all. So we will just ignore that. We'll just go quickly with holding period. What is the holding period? Again, this becomes important, because what should we take? for how many years the property has been held by the person, like 1 year or 10 year or whatever. So if it's something that we are acquiring, then it's very simple, right? We just go with the date of the acquisition. But if something which is coming through gift, inheritance, exchange, conversion, like kind, stock dividends, those kind of things, then we need to make sure what does the rule say, what should be the holding period that we should take, because it may result into short term or long term gains or losses if we don't have that holding period calculated correctly. We'll just go with some of the examples. If it's sale or exchange, obviously we go with the acquisition. If it's a gift and all, we usually go with the donor's acquisition, like when does donor has taken that property. Inheritance, it's automatically long term. Any like kind exchange, section 1031, we'll read about it later, meaning it's a like kind exchange. One property has been sold and a similar kind of property has been bought. Property or it's been exchanged. Any stock dividends, what do we do? The stocks that I bought for like 5 years back, dividends has been issued in today's date. So shall I take today's date as the holding period for the new stock? So what they're saying is you just take the holding period of old stock. Okay, that way all these examples are given. So we need to go with, like, for example, securities. What is the trading date, not the settlement date? Settlement may happen next week or whenever the price, like, sorry, the payment would have happened after a few days. But when was it bought? That's what we need to go with. If it's a futures transaction, then it's long term after 6 month holding and all that. Again, these are futures and options, and also the rules might be different for them because they are not regular capital gains and losses. They fall under a different category. So anyway, let's go over capital gain and losses. Again, the capital gain or loss is realized on the sale, exchange of capital asset, and like nothing so fancy about this sentence. It's everybody knows that, right? Any sale or exchange of capital asset, that will only lead into capital gain or losses, right? Not an ordinary gain or losses. So what is considered to be capital asset? Again, we have a lot of information, a lot of like points here. Inventory is not. Okay. So any real depreciable property also used in trade or business. Same example. Maybe it's a real property, right? The house is a real property. It's a real estate, we call it. Not like other properties are unreal, but for real estate we will call it as real property. So that doesn't mean that if it's just by the fact that it is a real property, we should put that as a capital asset. We have to understand what business is being run, what is it being used for. Yes, if a machine is constructed so that it can help in our own business, maybe it will make the production or make it more efficient by using some new technology and all, then we are using it for our own use, then it will be a capital asset. But if we are constructing something with the intention that we have to sell it off, and we are constructing 10 of them, 20s, 30s, 40s of them, then it becomes a stock. Again, we will see personal use can also be a capital asset, like our own house. If we are selling it off, it's a personal use property, right? But if we are selling it off at a gain or at loss, we have a right to claim losses, or we have a duty to pay taxes on it. It will be falling under capital gains and losses. Again, any property which is held for production of income is a capital asset, which is meaning we are using that property. In our case, we are using laptops to do our work and all, and to prepare the returns, and it's used in the production of income. That will be a capital asset. Again, we can have some capitalization rules that up to $1,000 or up to $500, we don't want to capitalize it, because again the amount is so small. So IRS says you can have your own capitalization. But the idea is not to burden the small businesses and all that. Okay, you have to follow this rule, that rule, and all. Otherwise, like their entire time and energy will go in these compliances. So some flexibility has to be given. They can come up with their rules saying that okay, above $2,000 expense we will capitalize, below that we will not. But I can take all of that as an expense. So again, the dealer property is not obviously, if there is a stock dealer, they're buying the thousands of millions of stocks every day and selling it off and all that. That's again their business. It's not you know a property or like a capital property for them. But if there is an investor who's buying stocks, maybe every day the person is buying stocks and keeping it with them, either for short term or long term basis, that becomes a capital asset. Okay, there are certain examples that they have given and all those things. And collectibles can be capital assets. They can be work of art, or maybe like some really handmade, hand woven rugs and all, any antiques, any precious metals and stuff. People have huge stamp collection, old coins collection, beverages, like some wines which are like 200 years old and something, and they'll go for very, very high price. So that people have these, hobbies of doing all these collections. So that may fall for capital asset. The depreciation, there's a different rules for depreciation. Amortization, there are different rules. But whenever you see this section 197, 197 is for amortization, something to do with intangible asset. It could be patents as well. It could be technology know-how and all. There are certain things you have given here. It could be trade secrets, rights, contract rights. Those are not tangible assets. So when there is a difference between goodwill, how do you want to do that? If it's something that we are generating in the business and we want to put a value to that, it becomes a capital asset. But when we are acquiring a business and we are paying higher value than the fair market value of that business that we want to acquire, that means we are giving extra amount, we are paying a premium that goes towards goodwill. So that will be considered as intangible asset, not technically a capital asset, because there's other rules applicable. Like the capital asset rules are not applicable to it. Amortization is a different way how to do amortization. Section 197 has its own requirements. Okay, so it becomes a section 1231 asset rather than capital asset. Now you will think, what is section 1231 asset? Section 1231 is usually a business asset and all, which is used in business. But there's a separate category for that because the tax treatment is different. When we call it this, okay, when we are selling off the property, the software also specifically asks us, is it section 1240 asset, 1245 asset, or 1231 assets? So we have to understand what is the nature of that asset, put in the right option so that the gains or losses are computed the correct way. Because it is quite a possibility the portion of those gains will go towards ordinary gains and the remaining can go towards capital. And that can make a big impact on the tax liability. So we need to this will be covered later, what is section 1231 asset, 1245 assets and all. But section 1231 is usually business asset. Let me see if I have something here that I can show. Yeah, here, this diagram. So if it's goodwill, if it's internally generated, it becomes a capital asset, it gets capital treatment. If it's purchased, it becomes a business asset under section 1231. Treatment may be capital or ordinary. We have to look into the rules of 1231. So option is treated same as underlying property. What is an option on? There could be a stock option, there could be some other option to buy or sell and all, or some different options and futures and all which is being traded. So it takes the same nature as of the property it is attached to. Okay, stock, bonds and all, we already know that, okay, usually if it's for investment, it will be capital asset, but obviously if a stock dealer or a broker is, dealing into it, that doesn't become an asset. It becomes like it becomes like his primary trade or business income. Dealer again meaning the full time they're doing trading, or traders rather. So we have to, but then there are certain requirements for that. Like we need to differentiate, is that's buy, all the purchasing and sales, are they happening in the nature of investment or they're happening in the nature of trading? For trading, there has to be really huge volume. Every day it needs to be done. There has to be a regularity, like how we go to an office every day and how like there is a regular business going on companies. So same way this person is also doing, but regularly doing trading and all, like buying and selling and all, then that becomes a business. It does not become a capital asset. They don't get any benefit of capital gains, lower rates and all. So the activity must be substantial. There has to be continuity, regularity, and all those things. So we need to see what it is, and it could be, this could be a relative term. What is substantial? Maybe in some countries, certain amount of trading could be substantial, but as compared to US, it may not be. So we obviously have to pay, attention to all these reasons also, or all these, like the background information also, what is being done. Investors will typically buy and sell for capital appreciation or for getting dividends, interest, and all. But traders don't do that. Right? Every day they do trading. Trading. So they just want to make daily profits and all. That has to be considered as a trading business, not as an investment. Although the same kind of property is involved in both the cases. So we have to use our own judgment and see what it is. Okay, so I think we'll just stop here now. I will continue this thing later on.